taxes that are owed here in California, you'll owe upwards of 30 to 40% if you're in the highest tax bracket. So all of that appreciation that you've built, you can lose a large majority of that. And so that's why you want to do the exchange. And then the Delaware Statutory Trust is just that next step for investors, right? They've owned the real estate, they get the calls on the weekends and in the evenings, and they're just tired of day-to-day management. The DST is the way for investors to have either built up that equity or they've just decided it's not for them.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us so we can explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. And welcome to the show, Ashley Romiti. I am stoked to have you here, excited to have you here. This is a topic that's coming up more and more in the circles of investors. I know for me and the people that I've spoken with in the tech communities, this is something that I don't hear that much. So I'm glad to have you here to shed some light on this. People have heard of 1031s, but not really DSTs as much. I'm going to hand it over to you to introduce yourself. We're going to dive into it. But a couple things just to kick us off that I thought was fun is that you were saying that you got into real estate, fell into it. You have an anthropology degree, but after graduating there and thinking about going into social work, you're in California, wanted to go to New York, and they told you the price for it. You're like, I'm not so sure. So that's how you got into real estate, right? I love that's the first one. And then there was one other thing you said that was really cool that I thought was maybe a moment you could tell us more about too, is that the first year you didn't make much money in real estate, commercial real estate, but the second year, the first building that you sold, you got a check for $20,000. You went to the bank, cashed it, and you have a picture with all of that in cash. What a cool moment.
Yeah, which sadly is not the biggest stack that you imagine, but yes, those are both true stories.
Awesome. Thanks for being here, Ashley. So tell us a little bit more about yourself, and then let's talk DSTs.
Sure. Yeah. Ashley Romiti. I'm president and founder of GCA 1031. So I've been working in the commercial real estate sector to some capacity for nearly 15 years. And like you said, this was not a career that I ever thought I would fall into. I grew up, thought I was going to be a doctor. I started UCLA as a neuroscience major, did some pre-med, realized I worked at the hospital, realized that was not for me. It was what they told you as a kid you needed to do, lawyer or doctor. And
Sure.
so I thought, I think Grey's Anatomy was out at that time. So I probably watched that and I was like, oh, I'm going to be like them. And I think the show's still on, funny enough, 20 years later. So I thought I was going to be a doctor, decided not to, shifted. My degree's in anthropology. It was something I was interested in and I didn't really know where to go. And so I ended up doing that. Applied to grad school afterwards, wanted to become a social worker, even moved to New York to go to Fordham University. And this was back then when you graduated with a master's in social work. Starting income at that point was around $26,000 to $30,000 a year. And I was looking at paying $60,000 a year for grad school. Math is what I'm good at. And that math is not making sense. So
yes, the ROI and all of that certainly kicked in.
I would love to have been able to do that, but I still had to pay. So I got an opportunity to interview at Marcus Millichap. And I ended up flying back to California that Christmas. It was right after Storm Sandy. Just New York was not for me. Needed something to do. I interviewed at Marcus Millichap, got the job, and that's how I started commercial real estate. And then I started working I'm in South Orange County in California. Started trying to work with retail investors. I'd go meet people in person, and frankly, I'd get laughed at in meetings. I was like 20, I was in my early 20s. I had these suits on. My mentor at the time told me to dress like Hillary Clinton. So I had plaid suits going. Anyways, No one took me seriously. So I ended up approaching the manager and we talked about it and we said, okay, you're going to work with 1031 investors and help them place capital outside of California. So my business was built on the phone. No one saw
Very
my
cool.
face. It was none of this was planned. It all just kind of fell into place because life threw a few curveballs. And yeah, nearly 15 years later, I work with those 1031 investors still. And rather than helping them, or in addition to helping them find your traditional triple net properties, I really focus on Delaware Statutory Trust.
Yeah, that's cool. You've been doing, I just touched on that. I remember hearing it was your words. You wanted to be the Laura Croft. That was something you had said while you went to college. Super cool. But it's a huge pivot, right? Huge pivot from, Laura Croft to real estate. So what was
But
that? I'm just kind of curious. What was that like?
which part?
Just thinking about, am I really doing this? What is this thing? Or is it like, I'll give it a shot? And I'm also wondering if you can recall was your family like? Okay. I guess what were your impressions of real estate as a pivot from your path?
Yeah, so I mean, I my mentality has always been very like fluid about where life can take you. At no point do I see that. I always tell people like when I hear 18-year-olds tell me what they're going to do, I kind of laugh because I'm like, you don't know, you're just getting into real life. You don't really know. You've been told these things. So my family was not at all surprised. It was actually my oldest brother who got me the interview at Marcus Millichap. And he wasn't surprised. He pitched me. He said, "Hey, Ashley, if you come work here, you have freedom. You get to go to lunch every day. You get to build your own schedule." And to me, I was in my early 20s. I had been working at jobs where you had to clock in.
Yeah.
To me, that was so enticing. Yeah, and it's proven like I have more freedom in my days than I ever thought I would growing up and being told you're going to show up to a 9 to 5.
Super cool. And now you're doing GCA 1031. So tell us what DSTs are. Explain this to investors who've never heard them
Sure.
in much simpler fashion. As I've mentioned before, these are tech professionals, so they understand systems and some tech stuff, but just a little bit simpler to start, if you could.
Yeah, DST or Delaware Statutory Trust. It's a long way of saying so you invest in a piece of real estate that's held in a trust. You're a fractional owner, but what makes these extremely unique investments is that they are 1031 eligible. So 1031 exchanges are tax deferred exchanges where investors can buy and sell real estate and defer their taxes. Typically, like a traditional syndication is not going to qualify for a 1031 exchange. So that's what makes the DST so unique is that it is that opportunity to come into much larger institutional deal, become a fractional owner, get the same sort of benefits as owning, but you get to use this tax deferred exchange to get in and out of it.
Cool. Awesome. And so in other words, from the 1031 perspective for if someone has a property, right? And 1031s is where you're deferring capital gains. So if someone wants to sell that property instead of paying all that tax there at the sale, they can roll that into something else, right? Just
Yeah.
taking a step back to define that. And
Yeah. And because a lot of your investors might be newer or growing, it is a way that has really been that path for investors to build their portfolios because they can go and they can buy, right, their first property. Maybe they buy a duplex, then they sell that and they go buy 4 doors and then they go into 16 units. So it's a way that you can scale and defer those taxes along the way.
Mhm. Okay, so if I'm understanding correctly, then if someone does end up selling, let's say, like that fourth property in the chain, right? They've bought one, sold it, rolled it over to number two, and then rolled it to number three, rolled it to number four over 10 years or something like that, as an example, right? On the last sale, on a sale, then they would be able to then work with you to place those proceeds into a DST offering.
Yeah.
Okay.
Yeah. So it's really designed for the whole reason for the 1031 exchange is that as you own the real estate, you get a gain, a growth in that real estate. So if you bought a property, for example, in 2017, the last decade, we've seen mass appreciation in real estate. So let's say that property, or let's take it further back. You bought it in 2010 for $500,000 and today it's worth $1.5 million. When you go to sell that property for $1.5 million, the taxes that are owed are, here in California, you'll owe upwards of 30 to 40% if you're in the highest tax bracket. So all of that appreciation that you've built, you can lose a large majority of that. And so that's why you want to do the exchange. And then the Delaware Statutory Trust is just that next step for investors, right? They've owned the real estate. They get the calls on the weekends and in the evenings, and they're just tired of day-to-day management. Or maybe, right, like for your audience, a lot of people hear about real estate and they want to get into it and they don't realize it's actually can be a full-time job, right? You're not always, once you scale, it's not just a few hours a month. You could be working part-time, full-time. So the DST is the way for investors to have either built up that equity or they've just decided it's not for them. They don't want to pay their taxes, but they still want to be invested in real estate. They still want to have that income. And though most of the time they can strategize to get the appreciation too.
Cool.
So that's where the DST falls into the kind of the timeline.
Got it. So investor property is going from active management to investing in a DST. So then it's passive. So then talk to me like what a DST offering looks like. And have questions come to mind is, what does a DST offering look like? How do these offerings come to you as well?
Yeah. So what I am is I'm technically a financial advisor. So DSTs are securities. So when investors come to me, they're not my offerings. I have the opportunity to work with some of the biggest sponsors out there today with just a full grasp of the DST industry, right? So last month, I think over 700 million was raised in DSTs. So these are, in last year, it was somewhere around 8 or 9 billion. So there's a lot of equity being raised. The sponsors who are bringing these deals out are going to be your Cantor Fitzgerald, Inland, Exchange. New players in the space include BlackRock, and a few other big names, right? So these are companies that have multi-billion dollars with assets under management. They have private and publicly traded REITs. So they're bringing them out. And there's smaller shops too. There's a lot of equity coming, a lot of players coming into the space. So what my role is to help investors understand these different offerings, look at the deals, figure out what's a good fit for them, because not every deal is the same, right? You'd never look at 2 real estate deals, 2 syndications, and just because they're from this company, you can expect that. So I help them navigate the industry. What we see majority today are deals in multifamily, right? Multifamily continues to be a sector that remains in demand. There's certain markets that are softening, right? You're out in Texas. Texas had mass development in recent years, and we've seen some rent softening. So we have the multifamily. Some other asset classes that you can get into are going to be industrial, your net leased retail. What else do we see today? I have a self-storage offline. Self-storage, but self-storage is funny because they developed so much in 2021 when rates were low and building was cheap. We're seeing a lot less inventory than what you might think would be out there. So those are the kinds of deals. But what's important about the DST is that the quality of the asset that you're going into, they are going to typically be your stabilized investments, core assets, strong markets where you have growth. And the reason is you go into a syndication, they can do a capital call, they can do value add. A lot of those strategies that they use on the syndications cannot be done with DSTs. DSTs, you can't do that capital call. You can't do major renovations. So by nature, these investments are going to be, like I said, more of your core assets in big markets, right? Well, we've seen some like in the Sunbelt states, but those have lowered. We're seeing a lot more in like the Carolinas, the Georgias. We're looking for markets where economies remain strong, where new industries are moving, and we're seeing the potential for the deals to continue to grow for the 5 to 7 year time frame that investors will be in.
Cool. So that's interesting that you were talking about how, making that comparison from some multifamily deals where they've gotten capital calls. I've definitely heard of them. I definitely know people affected. I've been affected by some myself. versus in these type of offerings, these DST offerings, they're not going to be, I don't know what's the appropriate way to say. Is it less likely or just not a thing of capital calls to happen with DST offerings?
Yeah, so it's really not a thing. There's going to be language that will protect the deal if they need to do a capital call, but broadly speaking, that is not what the DSTs are for. They are meant, when you look at the DSTs, there are funds that are even raised on the upfront called reserves, where those reserves are collected. They're raised on the upfront to literally manage the deal through the hold period. Because the idea for the investor coming in is that I have a client who they own 15 single family homes. They're tired of managing them. That's a full-time job. They want to sell them. They want to preserve the equity they've built, but they don't want to go back into active management. So they can sell one deal at a time
Mm-hmm.
and exchange into different DSTs. The PPM, the private placement memorandum, has the projected income, right? And that is based on the NOI of the property. Just like when you look at any other property, you're going to underwrite what's my cash on cash return through the hold period. So the goal for the sponsors is to meet those projections. So these aren't deals where you're going to come in and I'm going to tell you you're going to get 15% return. These are very low profile. Let's get you some income, preserve the equity you've built, and maybe some appreciation on the back end.
Okay, cool. That makes sense. So someone sells their property, invests into DST. Got it. These are going to be more stable, more because they're more conservatively written, so to speak. And what can you give any range? Every deal is different. You're going to have different offerings there as well. It's going to be deal by deal. But can you give a range? Is that appropriate here to talk about some types of
For
return profile?
income. Yeah. So if you look at the market, you look at institutional assets, the properties that we're looking at might be a 300 unit apartment building managed by Greystar, or a portfolio of properties that include Tractor Supply and dollar stores. They're going to fall in line with cap rates of those types of assets. Today, there's a range, right? Like you said, there's no guarantee. This is just broadly speaking, anywhere from 4.25 to 5.25 for the strong, more stabilized assets, not a lot of upside.
Yep.
You'll see deals out there, obviously, that have higher return profiles, but there's two things I always caution investors on those. One, right, if you're getting a 7%, 6% return on a real estate deal, there's going to be more hair in the deal, and there's going to be some sort of risk that you need to understand as to how they're able to achieve that. And then number two, make sure that the income is all coming from the property, that it's not, unfortunately, there's no like regulation on how these are underwritten and how their income is distributed. So most of the deals that I work at are going to be on the lower end, just because the clients that I work with, capital preservation is number one. So we're not looking for outsized returns, but there are strategies that we take one step further when we're looking at pre and post tax return, looking at where a client's basis is, how we can incorporate cost segregation studies. So that can also boost income, but that's going to be when we have conversations at a later date.
Yep. Yeah, absolutely. And so I'm curious with these two, from these offerings perspective, we're using syndications as something to contrast here. And, something that I think a lot of people that I'm thinking of right now, familiar with syndications, would know that there's, of course, a hold time, 5, 6, 7 years as an example. So do these DST offerings have a similar type of hold time, or is it a lot longer?
Yeah, so it'll typically be 5 to 7 years. Seems to be industry standard on when you can hit those numbers for investors. And right, there's some that right now that are 7 to 10 years. There's other strategies where it's called a 721 UPREIT, where you're going to move your equity from a DST into a REIT. That's going to be a 2 to 3 year old hold. And then once you're in the REIT, you have liquidity. But generally speaking, your traditional DST is going to be 5 to 7 years.
Okay, cool. And I don't know how far to go with this. Feel free to help direct the conversation here from here. But my question is that are you set that 721, I think you said upright, is that kind of what happens after the sale of a property? Is that the next logical step?
There's two different exits for DSTs. So the traditional, you're going to come in as an investor today. You'll be in the deal. If you have let's say someone comes to me, they have a single family home.
Mm-hmm.
They bought it. They thought they'd love becoming a real estate investor. Turns out not for them. We go the traditional DST route. They're going to sell their property. They'll invest in a DST. They'll be in that deal for 5 to 7 years, at which point the sponsor is the company you're investing with. They're the ones putting together the deals. They're going to decide when to sell, right?
Mm-hmm.
They want to hit the projections. They want to sell at a good time for investors. So they're going to sell. When it sells, those investors are going to be in their next 1031 cycle, meaning the proceeds from the sale of the DST will get transferred to the qualified intermediary, and they'll be in the same position they were 5 to 7 years ago doing the first DST. That's traditional. There's also what's known as a 721 DST, where, right, so 721 is another tax code. And what that tax code outlines is I could sell my real estate to a REIT, a real estate investment trust, and through the 721 tax code, it would be a tax deferred sale, and I would get operating units in that REIT. Most retail investors who are selling these smaller properties, who aren't dealing with $50 million assets, don't have that ability. So what the DST market has outlined for these investors is a 2-step process to get into the REIT, for the real estate investment trust. Whereas you invest in a DST today, in 2 to 3 years, a REIT buys that DST, the real estate in that DST. At that point, the investor converts from owning the DST to operating units of the REIT. And now they just stay in the REIT. As long as when they want to cash out, they can convert those operating units to common shares. That's a taxable event.
Got it.
But that's the other exit strategy. And who I usually recommend that for is someone who's really focused on estate planning, right? They just don't want to do 1031 exchanges. They don't want to do real estate. They just want income. That's what that strategy is more geared for.
Got it. Absolute masterclass. Thank you. I know we went technical, all the way through. I can't.
Very important though to understand, because marketing for DSTs is not clear about those.
Yeah, I bet. We'll chunk up a little bit here. Anytime I'm talking to people in real estate, love talking real estate. We'll go to a whiteboard and it's like, all right, here's the next step. Here's how this goes. And so the whiteboard gets filled with stuff. It's always pictures worth 1,000 words. Pictures worth a really easily defined flow chart. So thanks for going on that journey, Ashley. So let's talk a little bit about this. So it's a great way to go from active to passive, right? Basically, in a nutshell.
That's what it's like.
Cool. So what are some of the common misconceptions you hear? There's got to be a couple of maybe some common questions or anything like that you get from people. Or did we answer most of those things already?
Yeah. So a huge misconception is that DSTs are different or that you either do a 1031 exchange or you do a DST. And I always want to clear that up, because to get into a DST, you have to still do the 1031 exchange. And so I will get calls from people who are like, I just closed my property. I didn't want to do a 1031. I want to do a DST. And so they come to me and I'm like, unfortunately, you're too late.
Yeah. So that means then that someone wants to sell, they want to do a 1031. They have the 4 to 5 days to find some kind of property, right? Is it then that the DST is chosen as the target within 45 days?
Yeah, that you still need to identify the DST within those 45 days.
Got it. But that becomes the target versus another target property. The DST is the target.
Yeah, that is the replacement property. And so when you're doing the ID, we're doing it the same way as if you were to go out and buy a 4-unit. We're putting that DST property on the sheet.
Great clarification, because that's something that obviously, if you want to be successful with the DST, you got to know. So maybe some other mistakes. Are there other mistakes that people do or maybe lack of how to be best prepared when wanting to take advantage of a DST offering?
Yeah, so I'd say one of the big things is, so DSTs are not all the same, right? We hear the word Delaware Statutory Trust, And a lot of times it's sold as a product, right? So stating, oh, you're selling your property, you want passive income, you can go into a DST. DSTs, just like any other real estate assets, need to be analyzed by what I would say is three different levels. You have the sponsor level, you have the real estate, and you have the trust. And so you need to make sure that you're doing the due diligence on those deals, and that just because it's a big name, I won't say just because it's a big name, thinking, oh, this is going to be a good deal, because every investor has a different strategy that we want to look at, right? If a client comes to me and they're in their 50s and they have more risk profile, that's going to be a different investment than a client who's 85 years old who's living on the income. So it's really important to understand that DSTs are still real estate, and you need to structure your portfolio based on your individual goals. Because I know a lot of people who they go to a financial advisor who has one DST product on their platform. And I don't think that's a good way to serve investors, because you and I, we've been in real estate. I wouldn't have one property and tell every investor that they should invest into it. So that to me is a very big misconception in this space.
Got it. Got to have options. Definitely. Definitely. You said 3 layers: the sponsor, property, and trust. I usually hear that at 3.5, whatever, not to nitpick. Sponsor, property, market, and trust. But definitely those three layers. And I'm curious, since you brought that up, how do you, when you're talking about reviewing the trust, what do you mean by that?
Yeah, so that's looking at the PPM, the private placement memorandum, essentially, and seeing how that's outlined. The what if scenarios, we want to look at what are the management fees. We want to look at what kind of protection is there to the investor if something were to go wrong with the deal. Not just a lot of these are going to be geared up towards protecting the sponsor, but a lot of sponsors may take action that if a deal goes south, what actions are they going to take? And so it's understanding that aspect of how is this deal structured, and what are those what ifs?
Yeah. I think one of the many listeners might be thinking about is they probably have family or uncles or aunts or whoever, right? That even if the listeners here don't have these property, want to take advantage of the DST, they absolutely know people that might be a good fit. We've talked about how we go from the active investment to these passive DST offerings. Who are just refresh on this, the types of client profiles that would be best, because it's capital preservation, and you've talked about aging population as one. Who else can you think of?
Yeah, the typical buyer profile or investor profile is going to be that investor who's owned the real estate for 20, 30 years and they're ready to get out. A lot of the investors going into these deals are in their 70s and 80s. I would say a lot of my clients I do work with that younger clients in their 40s, 50s, 60s, because owning real estate, especially here in California, is not what it used to be. It is very difficult. Landlord laws today, maintenance can be expensive. It's hard to find good property management companies. So it's really anyone who's just tired of managing the real estate. Another thing that I always say to look at is investors need to look at their return on equity to make sure that the work that they're putting into the deal is worth it, right? Like investors who own here or own in major metro areas might look at their return on equity and it could be 2-3%, and yet they're still having to manage the real estate. So now that's the question: do you still want to be managing the real estate if you're getting 2 or 3% when you can go into something that's passive and get 4 or 5%, albeit, right, appreciation, all those kind of metrics will look differently. And then the third investor that we work with are investors who are active in the real estate market, and maybe they have some funds, which we call boot, left over in their exchange. So maybe they sold a property for $1 million, their replacement property is only $900,000. What are they going to do with that $100,000? They can go into a DST. It's a good way to try the DST as well. So I think my youngest client historically was about 35 years old. So that's pretty young if you're listening to what we're talking about in the strategy. My oldest client in their 90s, that's to be expected. And so it's less about the age and the demographic and more about that investor. How much time do they want to commit to the real estate? But yeah, a lot of the referrals that I get are, like you said, oh, my aunt or my mom or my grandma, they own this real estate and they're just complaining about it all the time. What can they do? And that's where I can step in and help.
Yeah, that's really cool. Two things that you mentioned popped out to me, especially like places like California is where you're talking about, and the DST offerings. They're like you said in Sunbelt. So you said North Carolina. I'm thinking Georgia, Florida, Nashville, Texas, possibly even Arizona, across the way.
Yep.
So how to take your active investment property that's in some place like California or Washington, Seattle, as an example, and go to some of these other markets through a DST offering. That was one. But then the second one you said is that if someone did do, you'll have to help clarify the details for me on this. But I think I had heard you say that if they did go into another property and there was something left to boot, what did you say? There was money left over or something?
Yeah, there's boot. So if you sell a property for $1 million, the 1031 exchange says that you need to buy your new property for $1 million or more, excluding closing costs. But let's say $1 million for easy math. If that replacement property you find is $900,000, you have $100,000 of delta left over. And if you don't reinvest that, you owe taxes. So that's what we call boot. I don't know if the story's true. I was told that back in the day when they had money left over in their exchange, they would literally put it in their boot, and that's how it was called. I do not quote that that's real, but that's what I heard.
People are fact checking with
And so they
ChatGPT
did
right now.
Yeah. So I don't even know how, history of boot, but that is a good way to test the water without having to go all in and see if, like maybe I like getting this paycheck every month.
That's cool. So that's how you would use the leftover to get to meet whatever equal value of property for exchanges, right?
Exactly. So someone can come to me and be like, I have $223,416.21. That's going to be hard to find a property at that value. So they can invest in a DST and they can invest to the penny. So from an exchange perspective, it's just great when you're doing planning.
So that was going to be my last question. I'm glad you took us there because people can roll over to 1031 into a DST, one offering or multiple. And what you just said is that they can invest up to the penny. So where, again, for contrast, syndications, et cetera, what might be 50 grand, 100 grand, or 250, whatever the tranche is. But in this case, you're saying to the penny. So how does that work?
Yeah. So usually the minimums are 100,000, but let's say a sponsor comes out and they're going to raise $50 million in equity. They'll just keep raising and it'll just every ticket or every investment that comes in just takes that 50 million. I'll get a notice, hey, we have 100 and this amount left over. We need an investor to close the deal. They don't have to, but like I just had a client close on a deal who took the last X amount and we just took that exact amount to close the deal. But they up until that point, the investor who comes in just allocates, okay, I need X amount here, and we can do it that way.
Got it. So long story short, you don't need those even or not so even numbers. Yep. You don't need those rounded numbers. You can still invest down to the odd number penny.
Yep.
Cool. Right on.
Yep.
I know we're just about out of time here. So I know we went deep in a lot of stuff. I enjoyed this. Thank you. So
thank you for having me.
Yeah, this was pretty cool. Anything industry-wise that is coming up with DSTs or any changes you are seeing, which you're seeing on the horizon that people should know about and maybe use as a platform to go get your guide and your website or listen to some other stuff?
Yeah, I'd say my biggest, like I mentioned in the beginning, there are so many new sponsors coming into this space and they're big names. There's a lot of quality real estate out there. But just like you do on anything else, whether it's me or anyone that you work with, I think it's so important for investors to work with an advisor where they can strategize on the portfolio and they can get the right portfolio for them, understand the different elements. And that's always my biggest thing with this is a planning strategy. Don't wait till your day 43. Have the plan before you close. So a lot of my clients, we talk before they list, when they're in escrow, because plans change, inventory changes, and just always have someone on your side who's watching the market, because the market, like, new deals come out every day. So you want to have visibility.
Yep.
So that's my
Gotta
biggest thing for investors.
Makes sense. Absolutely. Start early, get involved, keep the communication going, understand the plan as well for them. You got GCA1031.com as your site to come find your resources. I know you have a guide on there as well. I'll make sure that's in the show notes. For people that reach out to you, where would you like them to reach out to?
Yeah, so you can reach me on my website. My cell phone's on there, 949-235-5606. I just throw it out there if you want to call me. I love talking real estate strategy. Yeah. And if
Awesome.
I don't
Nice.
know someone, I say if I don't know someone, I usually know someone to introduce you to. So
Yep. Network. Awesome. Ashley Romiti, thank you so much for being here. Appreciate you. See you next time.
thank you, Steven, for having me.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in the future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.